Okay, this is John Paulamy of the Actionable Intelligence Alert. Today is Saturday, August 4th, 2018. And today I want to talk about some sediment indicators and some things that I have seen recently in the news that are giving me a view that we're in the bottom of certain resource markets and how I use various sediment indicators that are sometimes considered intangibles. The other thing I wanted to point out was just a little housekeeping here. Various people have complained or made suggestions about some of the noise or the audio quality. I did order a pop screen, so a lot of the popping sounds will hopefully go away. We'll have that probably next week. So I appreciate the feedback. And we're all about the customer service here at Actionable Intelligence. We want to make the experience terrific for everyone. So keep the suggestions and comments coming. I also appreciate the dialogue, feedback, and comments that we get in the videos comment sections. Everything's been civil and professional, and we've got a lot of good information. We get a lot of good information back and forth in there. So let's keep that up. I really appreciate that, guys. I appreciate the subscribers. We continually have more and more people coming on board, getting on board with this tribe, this contrarian mindset, seeking out these undervalued and contrarian markets. So welcome aboard for all the new people that are coming into our contrarian mindset tribe. So first things first, we had, this is a chart of uranium fuels. And here's a chart of UR Energy. It's a Section 232 petitioner along with Energy Fuels, and both these stocks basically broke out this week. I think this is an indication of some people positioning in front of the potential Section 232 ruling. I don't have any idea or opinion of what's going to happen there. I'm a long-term uranium bull. I would say that these stocks are a little bit overvalued right now in the short term. They've really been bid up. But this is kind of an indication of what can happen with some of these uranium stocks. They can move pretty quick. I mean, you virtually got almost a double in your energy fuels in 4 or 5 months. So same thing here in UR Energy. It's moved quite a bit also, not as much in a percentage wise, but you can see, take a look down here, look at the volume. There's a lot of people loading up here, and you can see the MACD and also the relative strength. Relative strength is getting into the overbought area. So not sure if this is just people trying to front run the 232 petition. I have no clue what's going to happen. Maybe some people already know what's going to happen. That's why they're riding these. But I thought it was interesting. The other thing is I believe Energy Fuels actually was added to a small cap index, I think, in the last couple weeks. So that would account for some additional buying just because people that manage money and use a benchmark used one of these indexes as a benchmark. I think it's the Russell 3000 small cap index or something like that. Anyways, they would have to go out and, as they rebalance the portfolio to mirror the index, they would have to buy Energy Fuels. That may be some additional volume also. So here's something I wanted to point out. I think a lot of people already knew that the uranium ETF, URA, Global X Uranium Miners, basically has been divesting itself of quite a few junior miners. That's been putting a lot of downward pressure on the stock prices in the last couple months. John Quakes has been very active in showing that on his Twitter feed. I think what's interesting is, from a sediment perspective, this is very interesting to me. This is what I call an intangible sediment indicator. What we know is people make dumb moves. They like to sell at bottoms and buy at tops. That includes people that run funds. That includes government officials. I remember back in the late 90s when gold was out of favor and nobody thought it was going to go up. It was stagnant in the like around 275, 280. Gordon Brown, who was at the time the head of the Bank of England, made an announcement that the Bank of England was going to begin selling its gold reserves at $280 an ounce. And subsequent to that, gold went on a basically 10 or 11 year bull market. So even masters of the universe like Gordon Brown get it wrong. So I think, most people do get it wrong when it comes to investing, and we've documented that in my sales literature for the newsletter. The average investor does sell at the bottoms and buys at the tops. That's just what they do. And that's because of sentiment, that's because of herd instinct, that's because of normalcy bias and some other psychological hurdles that one must overcome to be a successful investor or speculator. But I think what's good about this is that, with all of this positive news in the uranium market, I mean, we're just getting deluged with it week by week. And then, the fund managers for this particular fund decide to, as I've put in bold here, gradually reduce exposure to small capitalization stocks, basically the junior miners, which they've been selling off in the fund. So a couple things here. I think this is a good bottom indicator, sentiment indicator that this is the bottom, selling at the bottom. That doesn't mean we're going to go straight up in uranium stocks, but this is another indicator that we can use. The other thing is that if you are going to invest in the uranium sector, if you were planning on just using the ETF and being a passive investor, you're not going to get the full push you would get, because they've contaminated this fund now with a lot of companies like Hitachi or nuclear utilities and junk like that. That's just not going to move as the uranium price moves up. So I think people that are going to use this as a proxy to invest in the uranium market are going to be disappointed in the returns they see, and you would be well advised to steer clear of this. But as a sentiment indicator, it's another indication of a bottom. Here's another one that came out this week also. I've talked about gold in the past recently. I'm a long-term bull on gold. In the short term, anything can happen, but I think with the over-indebtedness, the pension crises, retirement crises in the West, just massive amount of debt, and I just don't see any way out for the Western welfare states. Money printing seems to be the long-term future. So that doesn't mean in the short term that gold can't underperform, and it has been. But what I think is interesting is one of the largest funds that was run by the Vanguard Group. It was called the Precious Metals and Mining Fund. It was basically all precious metals mining stocks. So the people that run this have decided that they are now going to change the composition of the fund and the name and call it the Global Capital Cycles Fund. I guess, with the underperformance of gold for several years, money wasn't flowing into the fund and attracting investment. It was stagnant. So obviously funds under management, the more funds you have under management in these fund families, that's the more fees that you can extract. And if you're not having a fund that's growing its funds under management, your fees aren't growing. So that's what this is all about. But I think it's also indicative of a bottom. I think that commodities in general are at all-time lows versus paper assets and the S&P index, and gold's no different. Gold is the anti-stock market. It's going to perform inversely of the stock market. I think we're getting close to the end of this stock market run. I'm not saying it's going to be imminent, but I still think we're going to have a blow off top at some point. But I think, this is another indicator, an intangible about sentiment, and something you can put in your toolbox. These magazine cover indicators are famous for predicting tops and bottoms. I remember in the late 90s, as another example, the oil price was trading, I think, around 10 or 11 bucks. And the Economist magazine, a very popular and well-read magazine on finance and economies, had a magazine cover about the end of oil. The oil price was never going to go up again, blah, blah, blah. And subsequent to that magazine cover, of course, the oil price recovered and went to 40 or 50 bucks a barrel. So These aren't guarantees, but I think when you take all of the other indicators in totality and you see these type of things coming in, these sentiment indicators, you know, like I said before, most people sell at the bottom and buy at the top, and that includes fund managers and that includes central bankers. It's just how it is. It's just psychology. Wanted to point this out again. This is a chart that shows the Goldman Sachs Commodity Index versus the S&P 500 ratio. And basically it shows you that relative to the S&P 500, commodities are the cheapest they have ever been, at least for many, many decades. Now that again is not a guarantee that commodities are going to go up. However, if you look at the past, you see that at major bottoms that were much higher than this current bottom, that over these type of bottoms in this ratio indicated turning points that led to multi-year runs in commodities versus the S&P 500. Now this doesn't guarantee commodities could go up. This could just be saying that commodities could stay where they're at and the stock market could come down massively. It could also indicate that commodities decline in price, but the stock market declines even more in price. Or it could indicate that commodities are going to rally and the stock market's going to come in from its highs and they're going to move towards each other. I suspect that's probably what's going to happen. This is a call that we've had for a while. I agree with this. We're playing this. It takes patience, but I think that it's like I say, I like to use these poker analogies. I think that the particular setup right now, the hand that we're holding indicates that in the past, you know, if you've got two kings, we're looking pretty good here on this draw. So I think that's why we're pushing chips in, and we believe that you know, the past is not a guarantee of future results, but the past is a guide, and when we see something this extreme, it does pay to pay attention. So guys, that's it for this week. Short and sweet. I'm going to have a blog entry on the blog. I'm going to review the new GNR second quarter report came out. These guys are pretty good on their forecasting of commodities. It's like a 30-page report that comes out every quarter. Talks about the oil market, talks about commodity markets, talks about the supply and demand dynamics, the underinvestment in oil. I'm going to be reading that for you. I'm going to be going through that and pulling out the relevant snippets. Growing and Rosenwag are extremely, the research is free. They give it away, and you guys should really take a look at it. I'll put a link to the report in the show notes, but I'll also be doing an in-depth review on the blog probably in the next couple days. So that's it for this week. Thank you for subscribing. Thank you for listening. Pass it on to your friends. Let's grow this channel, and I appreciate all the listeners and all the feedback. We'll talk to you next week. Thanks.